As a beginner options trader, it's important to learn about the common mistakes that are made in order to know how to avoid them. In this video, we will discuss the top 7 option trading mistakes that new traders make. By understanding what these mistakes are, you can take steps to prevent them from happening and improve your trading results. Real quick, guys, please hit the like and subscribe buttons below, as well as comment and let me know your thoughts on the video. Also, be sure and grab the free Simplified Options Strategies Trading Guide. I'll put a link down below. It covers the different strategies, setups, how and when to put them on, max profits, and trade management. It's a great guide to have by your side when trading options. Mistake number 1, trading illiquid positions. You will only be able to close or roll positions at a very unfavorable price if the option you are trading is illiquid. Illiquid options will often have very low volume and wide bid-ask spreads that can eat away at your profits. Don't kid yourself. Any spread or difference between the bid and the ask is literally money that is flushed down the toilet. We need to target only trades with high options volume and narrow bid-ask spreads so that we are not giving away free money. This will result in us trading only stocks and ETFs with less than 5 or 10 cent wide spreads. Mistake number 2, trading too many underlines. I like to have between 5 and 10 underlines or stocks at most. Having a max of 10 forces us to pick the best opportunities. It's difficult to track fundamentals, technicals, and other factors like earnings and earnings reports with too many different underlines. Positions often overlap, so one trade is similar and will react the same as another trade in a different underline. So why not just pick the best one? It also takes too much time when you have too many stocks at one time. It's difficult to move quickly and get filled in volatile trading sessions. Mistake number 3, trading too big. Trading too big can be both a mental and financial challenge. It's mental in the sense that you may not have the emotional control to handle large losses, and it can be financially challenging because if you don't have adequate capital to back up your trades, you'll end up taking on too much risk with your investment dollars. Focus on not blowing up with a catastrophic event. We never know when there will be a war or a political event or pandemic. Every few years, something happens that causes the market to drop significantly. Even if we have uncorrelated positions, when an event happens, everything suddenly becomes correlated and goes down. We have to be able to stay in the game by not over-leveraging ourselves and using excessive amounts of margin or leverage. These are the times when we want to have cash available to invest while everyone else is running and getting out. Always have about 50% of your buying power available when the market is average or above the historical average. Since we are trading options, we are using leverage, so we can outperform the market and stocks with using much less capital. People see the big gains and the potential and become greedy. They often don't realize that they are going too big until it's too late and something happens and they lose everything. That said, if the market has already been hit with a 20 or 30% downside loss, then we're probably safe having 70 or 80% or a little bit more on at that time with more positions leaning long. Mistake number 4, closing winning trades too early. If your average win is $50 but your average loss is $400, then you need to win 7 out of 8 times just to break even. That's a 87.5% winning percentage. That's tough to do just to break even. Taking profits early will boost your win rate, but at a cost. It will also eat up commissions. Figure out for yourself what win rate, max loss, and max win you want to shoot for. I like to have an average win of around 66% or higher, which seems reasonable. This would equate to a break-even of $100 for wins and $300 for losses. Be patient and allow winning trades to work to keep more premium. Mistake number 5, using the incorrect strategy and not analyzing volatility. We need to make sure that the strategy we are using is appropriate for our outlook and risk profile. The wrong strategy can cost us dearly. We want to sell options in high volatility. So selling puts, calls, strangles in high volatility is best. If the market is hit hard, then it may be an appropriate time to buy leaps with low-priced quality stocks that have already been hit and will bounce back. Mistake number 6, trying to fix broken trades. Accept losing trades and move on. Don't waste margin, time, and commissions. Human nature is to not admit defeat. At some point, however, there is a very low probability of profit, and at that point, it's both a waste of time and capital to stay in the trade. Know when to take losses and move on when the probability of profit is low. Mistake number 7, not having an exit strategy. It's critical to know when you will manage a trade and roll as well as close a trade and move on. Plan your exit strategy in advance. This applies to both profitable and losing trades. If you don't have a set-in-stone exit plan, then you may likely make costly decisions in the heat of the moment when a trade moves against you. The exact point at which you decide to close a trade, get out, or roll is really up to you. There are different thoughts and systems and strategies for managing and closing trades. Find out what you're comfortable with and how you want to manage your trades. We do have the free Simplified Options Strategies Trading Guide that outlines our trade management system, so be sure and grab that. I'll put a link down below. It covers the different strategies, setups, how and when to put them on, max profit, and trade management. Alright guys, please remember to hit the like and subscribe buttons below, as well as comment and let me know what mistakes you've made and what is working well for you. Thanks for watching and see you in the next one.